My income-oriented style of investing is very simple, it's very consistent, it's very easy, but just when I thought it couldn't get any easier, it does. What an awesome time to be an income investor. The creation of these new all-in-one covered call solutions or covered call ETFs makes it even easier for us to invest because they have the three things that I love most: diversification, covered calls, and leverage. So the trifecta for my style of investing. I'm talking about funds like HDIF, of course, from Harvest, or HYLD and HDIV from Hamilton ETFs. I would even put GDV and ZWG, the two global dividend focused funds from Brompton and BMO, respectively, into this category. So since these funds are already diversified, you don't really need as many holdings in your portfolio, right? So one of the most common questions that I have been getting in the last few months is, should I sell my individual covered call ETFs or sector specific covered call ETFs and swap them into these all-in-one funds, many of which already have the individual covered call ETFs anyways, right? So I'm talking about ETFs like HHL, which focuses only on healthcare, or HUTL, ZWU, which focuses only on utilities, HEP, CGXF, which focuses on gold producers. So should you keep these single ETFs or sector-specific covered call ETFs, or swap them into funds like HYLD, HDIV, or HDIF, which already include these ETFs? So I came up with 6 factors you should consider, and then I'll give you my overall thoughts on this and tell you what I'm personally going to do regarding my own personal portfolio. So easier, just got easier. Welcome to passive income investing. I just want to take a quick moment to thank the sponsor of this video, Harvest Portfolios Group, one of my favorite Canadian fund managers, really specialize in income-oriented ETFs or covered call ETFs. I own many of them myself, and they actually just released a brand new all-in-one income-oriented ETF called the Harvest Diversified Income ETF. The stock symbol is HDIF, which targets an 8.5% yield annually. So make sure to check out their website and their fund lineup. The links are in the video description below. So factor number 1 is, of course, yield. So obviously factor number 1 is pretty much king, right? With my style of investing, you want to achieve the maximum yield safely as possible, right? So because these new all-in-one covered call ETF solutions like HYLD, HDIV, and HDIF all use 25% leverage to enhance the fund, there's a pretty strong chance that you will probably get a higher yield by swapping your individual covered call ETFs, which are not leveraged, into these all-in-one funds, right? So obviously that's a big deal. That's a big advantage. So that's the first factor to consider. How much yield, if any, would you gain by doing the swap? So this would be different, right, for each person because we all have different book prices. So it's really up to you to do this calculation on your own and see if it's worth it. Point number 2, factor number 2 is diversification. So diversification, another important pillar in my investing strategy. The more diversified you are, the safer you will be across the board long term, right? Because you have everything. So swapping out the sector-focused ETFs like HHL, ZWU, TXF, NXF, etc. for the all-in-one funds probably will help you to diversify your portfolio better, as these all-in-one funds are extremely diversified already. So another big advantage there. However, keep in mind that if you're more of a conservative or defensive investor who really wants a lot more specific defense in their portfolio, it's never a bad idea to keep the single covered call ETFs that are very defensive, like ZWU, HUTL for utilities, or HHL for healthcare. So that's another thing to consider. Factor number 3 is leverage. So another thing that you should not overlook and take for granted is the leverage that these funds use. So this is traditional leverage, everyone, not structural leverage like split funds have. So it's literally borrowed money, right? It's a loan facility the fund managers use to get 25% more shares of the underlying assets. So you enhance your yield and your return by a cool 25%. Now, if you are a buy and hold investor like me, which buy quality assets, right? The underlying are always quality blue chip companies. Leverage really poses, my opinion, a zero risk factor. That's right, you heard me, zero risk. Let's think about this, guys. Yes, leverage causes stock prices to go down harder, 25% harder during crappy market conditions, but do we really care? No, because we have no intention to sell these assets anyways, right? This is why I always say I don't really care about stock prices. Only traders and growth investors care about that because they need to sell it at a higher price later on to make a profit. That's their problem, of course, not ours. We buy and hold and make our profit. We make our return with a consistent monthly income. So we don't make our profit and return with buying low, selling high later on. We make our profit literally with time itself. So this is why adding leverage is a perfect tool for the income-oriented, buy and hold-oriented investing strategy. Also, don't forget, like I mentioned before, the underlying assets, the companies or stocks that are actually inside these ETFs are pretty much all blue chip companies. So the quality is there. This is why leverage is really a humongous advantage, and you shouldn't be scared or worried about it, right? If you are leveraging quality stuff you're intending to hold forever, where's the risk? There's zero risk, right? So also another thing to keep in mind, very important point, leverage or the loan facility that fund managers use is much cheaper than the leverage or borrowed money we could get access to as retail investors because they're institutions. So they have very, very, very low interest rates compared to us retail investors. Point number 4, factor number 4 is capital gains or losses. So that's another thing you need to consider if you're planning to sell your covered call, your sector-specific covered call ETFs, right? If you have losses on them, remember that you cannot claim any capital losses in a TFSA or RRSP, and you never get that room back, whatever you lost, right? So that's an important consideration. In the cash account and the non-registered, it's a much smaller concern, if anything, if you sell at a loss, because you could always offset the losses with future capital gains, which of course you will always get some capital gains income from covered call funds. So because covered call income is pretty much all capital gains income, and don't forget that capital losses can be carried forward forever, no matter what, you will definitely, with time, no matter what, nullify the losses or the capital losses or offset them in your cash account. So don't worry if you need to sell your individual covered call ETFs for a small loss in a cash account. Don't worry about it whatsoever. You will make up those losses for sure. If you have a capital gain, however, good job. No taxes or anything to worry about in the TFSA or RSP. But in the cash account, of course, you do, but you have to pay the capital gains tax on it. But of course, not really a big deal because capital gains is taxed really, really well in Canada. Point number 5, factor number 5 is management fees. So this factor might actually be a con. So if you do swap out one of your individual covered call ETFs for a fund like HYLD or HDIV, keep in mind there's an additional management fee to pay on top of the other management fees of the underlying assets, right? So HDIF, HYLD, for example, holds 7 individual covered call ETFs. So the fund manager pays the fees for those, and on top of that charges a 0.65% management fee on top of that. So some people freak out because of this. Me personally, not at all. For starters, since the passive income these funds generate is all net of fees, it's no big deal for me, right? Second, the leverage, the cheap leverage that these funds use, the 25%, helps to offset this additional management fee. And third, even with the extra management fee, the fees are much less than mutual funds anyway, right? So this is where HDIF, the Harvest one, HDIF, really does stand out a little bit because it does not charge an additional management fee on top because the funds inside are all Harvest ETFs, right? So HYLD and HDIF do, but like I said, I'm really not worried about it in the slightest. Don't forget, guys, that the income is all net of fees. The fees are already included in the fund after you get the income. So before you get the income, sorry. Last factor, number 6, is simplicity, right? Less holding. So if you're swapping your individual covered call ETFs for these all-in-one funds, there's pretty big chance that you will have a smaller and more streamlined portfolio since you don't need as many holdings to be diversified, right? I know many of you love having smaller portfolios, 8 to 12 funds instead of 15 to 25. And hey, if it makes you feel better, if it makes you more comfortable, it feels like it's a weight lifted off your shoulders since you have a lot less funds to track, go for it. That could be also a pretty big advantage. So those are the 6 factors. So in short, there's definitely a lot of pros or advantages to swap the individual ETFs for the all-in-one funds. It's really hard to find negatives, in my opinion. The big advantage, in my opinion, is really the leverage. Okay, that's the number one thing in my opinion. It's the cheap leverage that you get. Don't forget that this is institutional leverage. These institutions get leverage or borrowed money at very much lower interest rates than us. So it's a lot lower than if we would use leverage in a margin account or in our cash accounts. Don't forget that. And of course, there is the strong possibility of getting higher yield overall from your portfolio. It could be more simplified, more streamlined with less holdings. So it's much easier to diversify a portfolio with these all-in-one funds. So there's definitely a lot more advantages than disadvantages. I think, in my opinion, it's a really, really good idea that you should consider. Of course, it's all a personal choice, personal opinion, right? So what about myself? Will I be streamlining and swapping out all my single covered call ETFs like HHL, ZWU for these all-in-one funds? Well, all will be revealed on March 27th when I, once again, as usual, unveil my entire portfolio to you guys. So that's when the next big portfolio unveil will be, March 27th. I know it's your favorite video. I know many of you literally just copy my portfolio, which is completely fine. I feel honored, and actually it gives me a sense of even more responsibility to all of you. So don't worry, I will keep unveiling my portfolio to you guys. We're all in this together. I will never abandon you through the good times and the bad. So stay tuned for that video near the end of the month. I'm very excited also about Sunday's video coming up, because I will talk to the man himself, the CEO of Harvest Portfolios Group, Michael Kovacs. You really don't want to miss this Q&A interview, guys. It's over 40 minutes of awesome conversation. We talk about everything, covered calls in general, income-oriented investing in general, the Harvest funds, of course, how they compare to their competitors or how they fare against their competitors. And of course, we're going to talk about this, their brand new all-in-one fund, HDIF. So you really don't want to miss it. Mark your calendars. Thanks for watching, everyone. I really appreciate it. Please show your appreciation by hitting the like button, hit that thumbs up button. It's free for you. It takes 2 seconds and it helps the channel grow. So it's a win-win. Also, if you like this type of content, this channel is all about investing for passive income. There's stock picks. I got a lot of great content coming up. I'm always thinking of new content. So make sure you're subscribed and hit that little bell button next to the subscribe button so you're notified every time a new video comes out. You don't want to miss my new content. We also have a website. Make sure to check it out, passiveincomeinvesting.ca. That's where you could purchase my digital product, the ultimate DIY investing package, which is on version 3 right now. I'm very proud of this product. It's a companion tool, a reference tool to really help you build your own portfolio, whether you're a Canadian investor or an American investor. There's sample portfolios in there according to different investing styles, not just income, what I do, but there's also some growth and dividend themed sample portfolios in there. And it comes with lifetime updates, so you only need to purchase it once. So make sure to check out my website for all the details on this product. There's also a video there where I show from A to Z what this product is, so make sure to check it out. Also on my website, I offer right there on the homepage a one-on-one consultation service with yours truly, me personally. It's a 1-hour Zoom meeting face-to-face in case you want more personalized help, where I go over your situation, help you build a portfolio according to your own needs, answer all your questions, help you transition a portfolio. Whatever your needs are, I will do my best to help you. I love doing these sessions. I limit myself to 4 a week. They sell out very quickly, so I apologize for that. I know many of you keep sending me emails. I always miss the consultation. Well, I can't do more than 4 a week because I need the time also to create more content. So just look at the little message on the homepage there, right on top of the calendar, to get a status if the calendar is open or not. But I will let you guys know via YouTube community post and a Facebook post when the new appointments are open. Speaking of Facebook, make sure you join our Facebook group, which is almost at 10. We're almost at 10,000 members now and going up. every day. So it's a nice little group where people post their questions, they put their portfolio, and we all try to help each other out when it comes to passive income investing. So make sure you join us there. We're also on Instagram. If ever you want to know a little bit more about our personal day-to-day life, you could follow us on Instagram if you use that social media platform. Don't forget, guys, the mission of this channel, my mission will always be the same. It's to help everyday, normal, regular working people to invest on their own in order to build their own stream of passive income to enhance your quality of life and one day become financially independent. So how do I always leave you? Make sure to continue staying safe, stay healthy, and of course, stay passive. See you next time.